All right, let's begin. If you didn't pick up your assignment, you can get that at the end of class. I've got A through L on this table, M through Z on the other. The grader's still working on homework 4. It's just that homework 5 was a little bit simpler to grade since it was those computer problems. One thing I wanted to point out is that when you print a spreadsheet, it's hard for the grader to know exactly what you've done unless you provide some instructions. And that's why on the handout I said that you should give a correct title to every column, and then under each column explain what it represents or what the formula was that you used. And so you can do that by hand or you can type it into the spreadsheet, but you have to give some little notes so that the grader knows if you have the right idea, or if you don't, the way you can get more partial credit is by explaining what you did so that the grader can understand maybe what are some of the key ideas you had correctly and maybe there was just one mistake. So don't just print out a page full of numbers that are difficult for the grader to understand. All right, let's look at these announcements here. On Friday, you do not need to bring your laptop. We'll just be doing some hand calculations that day. And also on Friday, homework 6 is due. And then our first exam will be on Monday. And I've already talked about that. So any questions related to the announcements? All right, let's just review briefly. Last time in class, we were trying to compare alternatives that have a different useful life. The options, when they have a different useful life, have to be somehow equilibrated or related to each other. And one of the approaches for doing that was the least common multiple approach, which relies on the repeatability assumption. And the figure's a bit small on the screen there, but you can see that you started off with one cycle, and then you repeated it multiple times until the cash flow diagrams ended on the same year. Whereas the contract service approach, what you did instead was you found some sort of an option that could be leased or rented. And so for the shorter one, it was extended. And during those years of extension, you have the same revenue as before, but now you're having to pay an additional outflow for the cost of leasing. And then the third option was to make the longer cash flow diagram, the option that has the longer useful life, terminated early by selling the item. So you may have a higher salvage value than normal if the item would have a salvage value anyway, or if it's the sort of thing that at the end of its useful life would be useless, what you're doing is you're selling it while it still has some sort of value to another buyer. And so that would leave you with a single one future value that then has to be discounted to the present. So all of these are examples of present worth analysis. In each case, regardless of what the method is, your decision is to find out which alternative gives you the most value at the present. And so at the end of the in-class exercise last time, I asked you which alternative is better. And it's always important to know the procedures, but just as important as the procedures is knowing how to interpret the criteria. So the criteria is the item with the highest positive present worth should be selected. If both of them have a negative present worth, then you have to seriously consider the do-nothing alternative, which is always on the table. So any questions in review from last time? So present worth analysis. Analysis means that we're trying to do decision making. In future worth analysis, again, we're trying to decide which option to choose, but in contrast to present worth analysis where we were taking everything to year 0 and then comparing the alternatives, in future worth analysis we take everything, meaning all the revenue and all of the costs, to some point in the future. And so the repeatability assumption may apply, and so if you have a different useful life, you can still use those same tools to conduct a future worth analysis. And so these 3 options, you can still use them to make the useful lives the same. But instead of taking everything to year 0, what you'd do is you'd move everything to some future year. And the reason why you might sometimes do this is occasionally you'll have projects where instead of just a single one-time investment at zero, meaning at the beginning of the project, there are a lot of construction projects in particular that require repeated investments over a period of years. And so the case is there's not just one payment up front, but it may take 3 or 4 years to build a development. And so in cases like that, sometimes the developer wants to know what's the value at the end of that period of investment. And so then they would compound the costs and the revenues during the study period to the future. So that's one illustration. Other cases is if you are going to be selling the item, then you want to know what it's worth at some future date. And so future worth analysis can help you to understand the value of a project in future terms, which is when you might sell the project, a business, or investment to someone else on the secondary market. Those are the applications. The procedure is pretty straightforward, and we're going to get a chance to work on that today. Before we did, I want to introduce just one idea that I think may factor into the next homework assignment, and that's called capitalized cost analysis. And it's a really simple idea that there are some investments that will pay revenue indefinitely. Instead of having the end of a cash flow diagram, they just keep going and going forever. And so an illustration of that is if you make a deposit to a savings account, then it's going to continue to pay you interest as long as the money is in the savings account. And if it's compound interest, then it may get bigger and bigger, unless you withdraw the interest each year. And that's what this cash flow diagram is showing. It's showing, for example, if you made a deposit of $500,000 to a bank, and let's just say that the bank was paying 10% interest, then this cash flow diagram is saying what would be the annual amount that you could withdraw from that bank account and still have the payments continue forever. Because if you take out too much every year, what you're doing is eroding the principal. But if you take out the right amount, then those payments can continue forever. What this formula is saying that the relationship between present value and annual withdrawals is just related to the interest rate. And so here, the unknown is A. And so you can find the value of the A by simply multiplying the present value by the interest rate. So that if it's a $500,000 deposit, and you are multiplying that by an interest rate of 0.10, so 10%, that means you can withdraw from the bank $50,000 every year forever, so in perpetuity. And so this is an idea that comes into play on the homework assignment, and we'll come back to it again when we are considering budgets. So A, in addition to an annual series, you can think of it as the interest on a perpetual investment. So here's that example we just did on the whiteboard. If you withdraw $50,000 each year, that is earning 10% interest, and that means you should deposit $500,000 today. So that's kind of the inverse of what we just did. So any questions about capitalized cost? Yes? Good point. So the value of the money is reducing over time. Yeah, so in year 1, maybe you can buy a lot of stuff, but by year 50, you're still only taking out $50,000, but you're not able to buy as many things as you could in year 1. So you're saying if you wanted to maintain your purchasing power, rather than maintaining the same amount? Yeah, there is a way to handle that, and we'll get to that later in the semester when we want to have what's called their real returns, which take into account the inflation of prices. And so if you want your purchasing power to be maintained, you have to take the inflation and the interest rate into account. And I mean, long story short, if I is your interest rate and F is your inflation rate, then I sub F is just I plus F plus I times F. So you would need to earn I sub F in order for your purchasing power to be maintained when there's inflation of F over time. We'll do some problems that relate to that, but since it's a simple formula, I just thought I'd show it to you. All right, so here is today's in-class exercise. You're going to be working on the computer, so I want us to get into it right away, so there's plenty of time. This has 2 pages. It's on the front and the back. The first problem here is a situation where the Port Authority is doing some channel rebuilding. And it's a multi-year project. Every year for 3 years, they're having to pay $220 million. And then based on that investment, then there are revenues through year 9 for option A. So you can think of option A as sort of like the complete rebuild option. In contrast, option B is more of a temporary fix. It doesn't require investments for a long time. You just do a one-time fix of $225 million, and then you're good for 3 years after that. All right, so what you should do is, as the handout states, were there any extras over here? There always are, right? Okay, so the handout says to use the least common multiple approach, which means since there are different useful lives, you're going to have to repeat option B. So you can draw the cash flow diagram right on the paper to start off with. And we've already done future values in Excel. Remember the column options when you're setting up a spreadsheet for future worth was you'd have year and then amount, and then there's 2 time columns. There's the year and then years until the future date that you're interested in. And here you should move everything to year 9. So again, there will be year, years until year 9, amount, and then future worth. All right, so I'll leave you to get started on that. Let's talk about the cash flow diagram. As I was walking around, it seemed like some people overlooked the fact that if you choose option B, you're going to have to do it more than one time because you need the shipping lanes to be open for a period of 9 years in order to compare these two alternatives. And so the pattern with option B is you spend $225 million and then you have 3 years of revenue. And so we have to do the dredging again at year 3 and year 6. And just like last class period, if we don't do the dredging until year 4, then that means the shipping lanes are going to be closed for a year. And so we have to have an outflow in the same year as we have the revenue for the 3rd year. So remember that 1 means the end of the 1st year, 2 means the end of the 2nd year, 3 is the end of the 3rd year. And so the end of the 3rd year is also the beginning of the 4th year. And that's why we do this investment again on the number 3 and the number 6. We don't, however, dredge the channel a 4th time at year 9. We just do it 3 times. And so when we look at the spreadsheet implication of this repeat, then you'll notice over here on option B, in year 3, it's negative 225,000 plus, negative 225 million plus 35 million. So that's where the negative 190 comes from, is it's the combination of revenue and outflow. And the same thing in year 6, but then in year 9, we're not going to do the dredging again. Yeah? What? Mm-hmm. Where? No, it wouldn't. It wouldn't work. Because, I mean, if there was, there are cases where you can use that formula, but it wouldn't work here because we have different amounts. You know, years 1 through 9 is different amounts. Sometimes it's 190, sometimes it's 35 million. So we can't use the PMT function in this case, not directly. Other questions? Now, remember I said the do-nothing alternative should always be on the table. And this is one of those times where you'd have to say, maybe we shouldn't do any project. And so it depends on who's engaging in this project. Is it a contractor that's hoping to make money off of this deal? You know, the government has said that if you do the dredging, then you can have the revenue that comes from the dredging. Or if you rebuild the channel. If that's the case, if you're hoping to make money off of this project, then you're going to be disappointed. But it may be that this is the government, and they have to keep the shipping lanes open regardless of whether they make any revenue or not. And so there are situations where even though you're going to lose money, you still have to do a project. And if that's the case, then you'd want to do option B. You'd want to do the periodic redredging and the complete rebuild of the shipping channel. Any other questions about this one? All right, if you haven't finished it yet, that's fine. We still have some time, but I wanted just to introduce and give some background about the second problem. So let's take a look at that one. All right, so in the second problem, you've got a family member who is making an investment and has 2 alternatives. One of them, if you pay in $250,000, then you get 11 years worth of $33,000. And then option B is going to have an annual return of $25,000, but option B, you're not exactly sure what the price is going to be. The seller hasn't given you a price yet. So the steps I ask you to go through here, A, B, C, first of all, A is draw a cash flow diagram that summarizes what you do know and then what you're trying to find. And remember, the convention that we've sort of used so far is that if you're drawing a cash flow diagram and you're trying to represent something that you don't know, so the amounts that are given would be maybe straight lines, and then an unknown amount you could use the dashed line or one of these big fat arrows, you know, like this. So we're trying to find some future amount. So when you draw the cash flow diagram, put on the present that is known, the annual that is known, and then clearly identify what you're trying to find on the cash flow diagram itself. So since you have all the information you need, you can find the future value of option A because you've got the interest rate, you've got the present payment that's going to be taken, and then the annual revenue for each of the 11 years. So you can easily find Part B here where it says to find the future worth in year 11. But then Part C is going to be a little bit more tricky. The idea behind Part C is trying to figure out what's a fair price for option B. Because remember, the seller hasn't told you how much it's going to cost yet. So the way that you find a fair price is that you have a blank spot in Excel. You set it up just the same as you did in option A, but you keep playing around with the value in year 0 until it gives you the future value that's equal to the amount found in Part B. So once you've finished step A and step B, then Part C I think will be a little bit more clear. But I give you the hint there on how to use GoalSeek to save you a little time rather than iterating it manually. All right, so I'm just going to talk you through the goal seek if you're still working on that part. So we don't know initially how much he's supposed to pay, so we just have to put in a guess, like maybe he's going to pay $1. Of course, it's not $1. So if you go to Data, What If Analysis, Goal Seek, then what we want to do is we want to find out for option B, how much should he pay so that the sum of the future values is the same as the sum of the future values for option A. So we're going to set, we want this cell to be equal to the 51046 by changing the price that would be paid in year 0. And then you tell it to iterate, and it goes and finds the amount. So it's 181,768. So that's what I wrote down here, is that if your uncle pays that amount, then the two investment options are equal.